Welcome again. This is Dr. Kent Gregory, and we are following Jordan Millen Dolvin's Fundamentals of Investments, ninth edition, and we're continuing on with Chapter 3. So we're now moving into Part 2, and we've just finished covering interest-bearing financial assets as well as equities. So we went over money market instruments, fixed income securities, common stock, and preferred stock. And now we're going to talk about derivatives. And specifically for this section now, we'll talk about futures. So futures contracts. First, some notes. There are two types of assets: real assets, which are tangible items, and financial assets, which are essentially pieces of paper describing legal claims. And then second, financial assets can be divided into primary and derivative assets. The primary assets are is a security originally sold by a business or government. An example of this would be stocks or bonds, stocks and bonds, for example. And derivative assets, these are financial assets derived from an existing traded asset, rather than actually being issued by a company or government to raise capital, which is what stocks and bonds do. They raise capital. So a futures contract definition in one phrase is an agreement made today regarding the terms of a trade that will take place in the future. So an agreement today for a trade in the future. There are two types of futures contracts: financial, where the underlying asset is intangible, usually stocks, bonds, currencies, or money market instruments, and commodities. So in which case the underlying asset is a real tangible asset, either agricultural, like cattle or wheat, or a natural resource, like gold and oil. So a short example of a futures contract: suppose you make a contract with a dealer to buy 100 ounces of gold in 6 months at $1,200 per ounce. So in 6 months, you pay your $120,000, so 100 ounces times the $1,200 per ounce, and receive your gold. So you've locked in the price of gold now, but what if the price rises to $1,350 per ounce in 6 months? You've saved $150 per ounce by locking in the price. Okay, so now let's move on with futures contracts. And here are price quotes. So first, some notes. Futures contracts traded on exchanges are standardized. So what this means is that one contract calls for the purchase of a specific quantity of the underlying asset, what that asset is, and where it is to be delivered. So for example, one wheat contract specifies that 5,000 bushels of a particular type of wheat, and there are a number of types of wheat, will be delivered to one of a few approved locations on a specific date for the agreed upon price. So let's consider this table that appears in this slide here. I pulled this on September 17th, 2020, and this is for a 10-year Treasury note. So the total par value, also known as the face value, is $100,000. The source is cmegroup.com. And when we go through the columns, this is what we're looking at. So the month is the delivery date. The columns, where it says last, this is the current price. And that was the current price as of this updated time. The change is the change in that current price from the prior close. And that prior close is the prior settle. And then the open price, that's the price at the start of the trading day on September 17th, 2020. High and low are the highest and lowest prices of the day, and volume are how many contracts are or have been traded on the current day as of that time. So that's the volume. So that's how you read this table from cmegroup.com. So This is our same table that we were just looking at. So an example of how futures contracts work. Consider the table from the previous slide, which I've got right here. So this is that same slide. Suppose you buy one December 2020 price at the current settle price. And the current settle price is last. Okay. So it's in that last column, or the column rather that says last on it, not the last column. But anyway, so should you do that, you have thus agreed to buy Treasury bonds with a total par value of $100,000 in December of 2020 at a price of 139 and then that comma 160 per $100 of par value, where the 160 actually equals 132nd. So this is so 139 comma 160 can be written as 139 and 16/32, which represents a price of 122,500 per $100,000 face value. So we continue. So futures contracts, gains and losses. Futures have the potential for large gains and losses. So consider this situation, and this is from the book. Again, we're using Investments, ninth edition, 2020 from McGraw-Hill, and this is from Chapter 3. So suppose on the 15 March, let's say, the Treasury note contracts for a price of 121,265 per $100 of par value. And let's say 1 month later, because of falling inflation, the futures price for a March delivery rises $5 to 126,265. This generates profit to you because you had locked in a price of 121,265 per $100 of par value. So your profit is $5 per par value, or $5,000 per $100,000 face value. So with 15 contracts, your profit is 15 times 5,000, which equals 75,000. So that was your profit. Of course, if the price had fallen by $5 per par value, you would have lost $75,000. So that concludes our brief discussion. Hope you liked it. Hope you understood it. A brief discussion of derivatives, in particular futures contracts. Thank you much.